Hello and welcome everyone to this edition of the Research Roundup monthly video. My name is Chris Kuiper, Director of Research at Fidelity Digital Assets, and I am joined by my colleague, Daniel Gray. We've got a great show for you this month. We are going to talk about the recent price action as always. We'll definitely look at some recent catalysts, or perhaps not, with the Grayscale decision and FASB. Daniel's got a few updates on Ethereum for us, some things that he's looking at. I've got a macro chart that I've been studying recently as well that we want to round out with. And then we've got some fun stuff at the end, as well as a lot of our research that we want to plug that we recently released. All right, so let's get to it. Bitcoin and Ether returns compared. This is year to date. So once again, we had that strong out of the gate performance year to date. We went up 80% for Bitcoin, almost the same for Ether. Since then, we've really been trending sideways to down, digesting a lot of those gains. Bitcoin really pulling ahead here as well, still up 55% or so, while Ether's up only around 35% now year to date. Really, if you look over the past summer, now that summer has kind of officially come to a close, we had a move up in both of these assets at the beginning of the summer and then a move right back down. So we were basically exactly where we started at the beginning of the summer compared to the end. So we really had those summer doldrums, as they used to call in the traditional financial world, and volatility declined along with it. So we're excited to perhaps get some volatility back here, hopefully good volatility, not bad. But we did get a couple recent catalysts or potential catalysts, as we'll look at here. The first one, we covered this in the newsletter, so go and check that out. So I won't spend too much time on it. But obviously on August 29, we got the court ruling in the case of Grayscale versus the SEC. The court did rule in favor of Grayscale, saying, quote, the SEC was, their words were arbitrary and capricious in denying the spot ETF. So contrary to what some people think that this means a spot Bitcoin ETF is imminent, it does not. I'm not a lawyer or anything, but I understand there are a number of different things that could still happen. The SEC could appeal the decision, in which case it then goes back, or the SEC could come back and deny the spot Bitcoin ETF for different reasons. So these are just a couple of the options out there. There's other details as well that we won't get into, but just note that there's still a lot of things moving parts here, and it is not as certain as some people might lead you to believe. Bitcoin, of course, appreciated on that news, up 5 to 6%. But then maybe it kind of turned out to be a nothing burger in some people's eyes, because just a few days later in the week, the SEC came out with their decision delaying a bunch of spot Bitcoin ETF applications for another 45 days. Bitcoin's price gave back all those gains that it had just got earlier in the week. Then one thing that did happen recently, and I don't think this made this in the newsletter since it happened after it went to print, so to speak, but FASB. Many of you are familiar with FASB, the Financial Accounting Standards Board. They unanimously voted to adopt new rules regarding how businesses account for crypto or digital assets. And so if you're familiar with this, before there really weren't any rules out there, and companies just decided to put them on their balance sheet as intangibles, something like a patent or goodwill. And if you know the accounting rules around intangibles, you often have to check the value of what you think it is versus the market. Obviously, with something like Bitcoin, it's very easy to check the value. And if the value has gone down from your purchase price, you need to mark it down accordingly. And so you have to take a loss. You have to show a loss on your income statement. So it's a blow to your earnings. And then if the price goes back up, you are not allowed, with intangibles at least, to mark them back up. You're only allowed to mark it back up and recognize the gain when you sell it. So the rule that they voted on was to change this to fair value accounting. So this would be similar to accounting for other investments, where there would be a mark-to-market accounting every quarter or however often they report. So they could go up or down. So previously, this was a one-way street. You could only mark it down. It could only hurt your earnings, never help them unless you sold it. Now you can mark up or down, or at least once these rules go into effect. The formal standard is expected to be issued by the end of this year, but it won't take place or effect until the annual report for 2025. But companies can adopt it earlier. So we may see some companies do that. To play kind of the contra some people think this is very, very bullish. On the other hand, some people say, well, this is great, but it's just going to introduce a lot of noise and volatility into earnings. That is probably true. These assets are very volatile, so it is going to then swing companies' earnings around a lot, especially if they do hold a lot of these assets. But I do think optically this could help. I mean, we have heard from a lot of corporations that this has been a hurdle for them on the accounting side. So it remains to be seen once this goes into effect if it really will spur on more adoption. That, of course, is the ultimate question. But an interesting development nonetheless. All right, so Daniel, let's turn to Ethereum now. What have you been looking at, and what do you have for us today with the Ethereum ecosystem?
Yeah, sure. So if we start here with daily net issuance, this chart, high level in blue, deflationary supply change when fees outweigh the issuance, and then the opposite in red, when issuance outweighs fees. And so the past 10 days here, we've been inflationary, but the past 3 months, you can see that we're jumping in between inflationary and deflationary. And this is likely because a lot of user transactions are going over to layer 2 protocols incentivized by lower fees. But it's important to note here that the assurances between layer 1 and layer 2 protocols are not the same. So where most transactions go through a single entity on the layer 2 platforms, layer 1 offers censorship resistance, liveness due to the decentralized validator set. And so this is a balancing act that we expect to see as users jump between layer 1, layer 2, depending on what kind of transactions and security assurances are important to them. Alternatively, if we take a look at the staked validator count, it has been increasing. So if we go to the next slide here, this will show us how quickly validator count is accelerating. And so last month we mentioned an acceleration in this red line here, the maximum validator churn limit. In the past few months, or since Shapella really, this has been accelerating. And so if we start here, this is when Shapella happened. You can see that the active validators count has actually increased 40% since this date. And so this is important because as the validator set grows, transactions need to be spread throughout all the nodes through what's called a gossip protocol. And depending on the user's bandwidth and hardware, this can start to slow down. And so we might start to see more validator finality, validator set finality breaking down, as well as maybe a few chain splits. And so there's been a proposal, two different proposals for how to fix this short term, at least. One of them is capping the maximum validator churn limit at around 12 validators per epoch. And currently it's at 11. But to kind of put in perspective, like how quickly this is accelerating, we could be at 17 validators per epoch by the end of this year. And this proposal is not set to be accepted or really adopted by the user set until later this year anyway. So this is something we'll definitely be paying attention to as time progresses.
Yeah, so I mean, is it fair to say in some ways this validates what we thought, where once Shapella happened, we would get more validators, more people wanting to stake. We're seeing exactly like that 40% you mentioned. And this is almost kind of a good problem to have, right? I mean, you want more validators, you want more security, but you know, this highlights just another kind of characteristic we've seen with the Ethereum ecosystem, where with every change and upgrade that fixes one problem, there are some other, I don't know what you want to call them, side effects, but some other things that get introduced because of that, right? And that's just natural because you're changing one thing, so that has downstream effects. And so now they're facing kind of another issue that might require, or they want to propose to change to fix that as well. Am I getting that correct, or is that kind of unfair?
Yeah, exactly. So like each change has technical difficulties down the road compared to like the economic weight that it brings. And so as this increases, it doesn't raise the security as much as it raises problems within node speaking to each other through this gossip protocol.
Yeah, interesting. There's always these tensions that we see from technicals versus incentives, the economics, the security. So it's interesting to see how it plays out, and then how people are proposing to kind of tackle these things. So something you'll certainly be keeping an eye on. I know Max on our team is definitely keeping an eye on as well. And we'll talk a little bit more about the Ethereum ecosystem at the end here as well. All right, so I'm going to round out here with a macro chart that I've been focusing on. So this is a chart of the US M2 money supply, so a pretty broad measure of the total money supply in the United States. And what's interesting about this data set is it goes back all the way to the late 1800s. So it's actually two data sets combined. You may have seen this floating around from other research shops, but we always source the research ourselves here. We don't just copy and paste from some other person, or take it for granted that they did it correctly. So I actually had to take two data sets, one from the United States Census Bureau. They have a book out called Historical Statistics of the United States from 1789 to 1945. That was published all the way back in June of 1949. And then it ends there, and then the Federal Reserve data set picks up from there with M2. So those two are combined. One little note here, I'm not trying to commit any chart crimes, but if you see towards the end on the horizontal axis, the date, it changes there from years, and then you get the full date. That's because I just switched to quarterly data there. So it's still year-over-year change through the whole chart. It just gets a little more granular there to quarterly data. That way we can see what the latest is, rather than only going through the end of last year, 2022. All right, so the first thing you notice about this chart is, number one, we don't go negative very often, right? And I've highlighted that with the orange circles. Number two, the last time we went negative was during the Great Depression, of course, that huge spike down. And there's a reason for this. After the Great Depression happened, this really burned into the minds of not only everybody, but certainly central bankers, this experience. And central bankers vowed never again to let the money supply contract, especially contract so sharply. And you've even heard things like when Ben Bernanke was Federal Reserve Chairman, he even said this in his testimony: we will not repeat the mistakes of the Great Depression. And so that's why since then you really haven't seen a contraction up until today. So the question is this time different? The other thing to note is every time it has contracted, I don't have them put in the chart here like lines or dates or notes, but if you know your market history, if you look at all of those spots, those were the same times things that happened, like banking panics, financial crises, depressions, or recessions. Now, of course, causation is not necessarily correlation, so they might have just happened to happen at the same time, although I personally believe there's reason or good theory to think the two are connected. And of course, the past is no indication of the future. So just because this happened before in the past doesn't mean a contracting money supply today is going to cause bank failures or panics or crashes or depressions. The other thing to note about this is you could say, well, actually, maybe it does, and we already saw it. We already saw a handful of banks go under this year, so maybe we've already had that episode and we're now getting past it. But the bottom line here, especially for Bitcoin and other digital assets, is that as we've shown in our research, our newsletters, and we talked about these videos before, Bitcoin and digital assets are very sensitive to changes in the money supply. So if you have a contracting money supply, that's a big headwind for these assets, right? So it's not surprising at all for us still to be kind of in this bear market when we have this pretty rare contraction in the money supply. So this is definitely going to be a chart we're going to be keeping an eye on. We'll be updating and revisiting as well. So if or when that turns positive, we would expect that to turn from a headwind to a tailwind to digital assets as well. All right, I think we got time for a real interesting story that happened just this last weekend, Daniel. Daniel he has maybe an odd hobby of watching the blockchain sometimes. He's noticed some things actually as they've happened live, which is kind of fun. But you can see the blockchain adding transactions in real time from certain websites like this one, mempool.space. This is a screenshot of one transaction. Daniel, what is particularly unique about this one here? What's going on?
Yeah, so in this transaction, the user overpaid by 481,000 times what was required to get this included in the next block, right? And so we can see at the top here, the fee was over $500,000. And in the diagram below, if you look at this large band right here, this is actually the relative size compared to the rest of the transactions. And so you can see the fee outweighed all of these other transactions by a lot. Another interesting part is one of these transactions actually accounts for $1,700, and it's going back to the original address that sent the money. And so this could be a change address. We can only really speculate what the use of this was for. But basically, this user paid more than $500,000 to send $300 to 4 other different addresses that we can't really tell whether or not was theirs or not. So the amount of fee here compared to that $300 is incredibly big mistake. We can't really say what it is, though.
Yeah, I think that's true. I mean, the Occam's razor, the simplest explanation is this has to be a mistake, right? Why would you pay over $500,000 to send $200 or $300 worth of Bitcoin when at most, if you wanted a real high priority transaction, cost you a couple bucks, right? But who knows, maybe there's something else going on. We can only observe what's public here. But let's say it was a mistake. If it really were a mistake, I guess it's just a reminder that if you are doing it yourself, like if this was somebody using their own software or some other software that maybe had a bug or something, you better double, triple, quadruple check things like this. And it also, I think, maybe makes a point of, this is where the value of other infrastructure comes in. This is where something like a custodian or a platform can provide a lot of value because they're going to have some checks against this kind of stuff. They're not going to want their customers to be overpaying on fees, even a little, let alone something as egregious as this. So definitely one of the oddest, weirdest things we've seen so far. This is easily the highest fee ever paid to a miner, I believe. There was maybe one of over $100,000 at one point, and there's been a few hundred over $10,000, I know. But this definitely takes the cake. So we'll see if anything resurfaces as to who this person is or what happened, but interesting nonetheless. All right, so that does it for us. We are going to plug our latest research here in case you missed it. We recently released a long form report, a PDF called Ethereum Investment Thesis, Ethereum's Potential as Digital Money and a Yield-Bearing Asset. So if you remember before, we've done a primer on the Ethereum ecosystem. This one goes a lot further. It goes a lot deeper into why would an investor want to hold Ether, the token? How does value accrue to the token? What's the investment thesis behind it? We present 2 in particular, and then we actually model the investment thesis as well. So you can play around with the inputs on your own, and it just gives you a framework as to how you would model and think about Ether as an investment. And then we also refreshed a shorter piece called the Omnibus Model for Custody Revisited. So this is why Fidelity Digital Assets uses an omnibus structure or model. So definitely check that one out. It gives a lot of the pros and cons for it and against it, and so why we chose the structure that we did. So that does it for us. Thank you for tuning in. Join us next month for our Research Roundup video. We'll continue to monitor these trends, look at what's ahead, and make sure we're keeping you abreast of all the latest developments and what to be looking out for. Thanks again. Talk to you next time.